Welcome back to Management 720. Let's get started with Chapter 11. Fitting Chapter 11 into the overall picture of what we've been studying, Chapters 1 through 4 were short-term decision-making based upon contribution margin. Chapters 5 through 8 were allocating indirect costs so that we could have accurate costs for accurate pricing. And Chapters 9 through 12 are long-term decision-making. Chapter 9, we looked at budgeting. Chapter 10, what happens when the actual results don't equal the budget. We have to evaluate the variances. And in Chapter 11, we've actually got a little bit of a grab bag of various topics. When companies get pretty big, they have more than one product, they have more than one divisions. So here are a couple of topics talking about larger companies and what do we do, some of the information we need to parse when we're talking about business divisions, and we call these different types of segments, business segments. Okay, let's take a look. The first thing we want to take a look at is we want to expand our concept of the normal variable costing income statement. If you remember, variable costing income statement, different than GAAP, is sales, and I'll just point out here, sales minus variable cost equals contribution margin. Those should be hopefully very familiar with you now. Less fixed costs. Don't worry about the word direct. And this is where we would end up. We would end up on net income. But you notice it doesn't say net income. Net income is here because we have now divided up our company into different segments. So the first thing we want to look at is, before we get to a total net income, we want to look at the margin for each segment. And then there's a division income, which we'll talk about in a second. And then there's a total net income. So we're adding on a couple of other, levels below our normal income. The first one would be the segment margin. The second one would be the segment income. Now I'm using the word segment, but it does say divisions. It says products, and it says territories. A segment is sort of the generic word. A company can divide up its company in many different ways. These don't want to use the word twice. These different ways that you can separate the company are called segments. Now, whether you separate it along divisions or products or territories, those are all different types of segments. Unfortunately, the textbook sometimes doesn't clarify that they're talking about a segment. They'll just say division margin, product margin, territory. Here it's territory margin and then territory income. But just recognize that we're dividing up the company to look at it in a bigger company. We're dividing it up into smaller parts that we can analyze each part, even though we do aggregate it into one number at the end. So just remember, it's sales less variable cost equals contribution margin per product or per separation, whatever the segment is. So there's a segment contribution margin, then less the direct fixed cost for that particular segment is the segment margin. Now, depending upon what you call that segment, a division or product or territory, it could be any of those. And then we have this, so we have direct costs. In other words, those are the costs that are used by this particular segment. And then there are allocated costs. Allocated costs are the ones that they are additional costs, they're additional overhead, but they're not generated directly by each division, but they may be used by the division somehow. And so there's been some way to where they've spread those out. Now notice that there are some unallocated common costs as well that are only applied to the total. And the unallocated costs are things like maybe headquarters or stuff that they really couldn't justify applying to the operational divisions or products. So contribution margin is still sales minus VC, segment margin. And when we get to the homework, you'll see that all those homework problems are pretty easy in this area. It's just recognizing what they're asking for. Segment margin is the contribution margin less the direct fixed cost, and they could call that a division margin, a product margin, or a territory margin. And then segment margin is taking whatever this the segment income is taking the segment margin less the allocated cost. So all we've done is add like two extra layers. We've added a division margin and a division income, or product margin, product income, basically a segment margin and a segment income. And that's just different ways for us to take a look at things. The second learning objective, so if we've got different divisions in the company, well, sometimes those divisions interact. I mean, if they're products, the segments are products, the products probably don't interact. In other words, the golf equipment for Nike probably doesn't interact with the soccer equipment for Nike, or the shoes or the clothing. So there may be some spillover. But when you have a division, when you're separating your company among divisions, probably there's a production division, there's a sales division, or something like that. And so one could potentially be selling to the other, and they could be potentially selling externally. So a big part of a larger company when you have divisions is if those two internal divisions are selling to each other, what is the price that they're selling between themselves? Now, this has to do with there's a lot of, I guess, ideas and thoughts about what is best for the company. And so I will give you the basics. And that's what we have here at the top. Is up here at the top, we have what I think are the basics. And then we have a number of different ones that they explain in the book. So what is transfer pricing? It's a sales between the company divisions. And what you're really that may not be the focus of what you're doing, but what you end up doing is, where do you allocate profit? In other words, if one division sells at cost to another division, well, really, you're basically saying, well, the selling division who's selling it at cost is transferring their ability to make a profit to the buying division. So the seller, if we're going to determine a floor and a ceiling for this price, remember back when we were talking about contribution margin and doing a special order. We said a special order for a company, in other words, they already had their production assigned, and part of that assigning production is maybe they have a certain amount of capacity they're selling. Currently, they're making and selling less than capacity, but what they're selling to current customers already takes into account to all the fixed costs. So any new special order that comes in, we remember way back then we decided that we wouldn't, since fixed costs were already covered by existing customers, we would only consider variable costs, which are the incremental additional cost to make any extra product. We would only consider variable costs as our costs of doing business with the special order. Well, this is sort of the internal pricing model as well. A seller probably has, the selling division probably has some external customers that they're selling to, and their fixed costs are covered by those. So if an internal division wishes to buy, then the selling division won't sell for less than variable costs. They need to cover the cost to actually make the product to sell to the buyer. Not that upper management couldn't force them, but if a selling division had its choice, it would not sell less than variable costs, because that would be losing money. So that would be the floor. And if the seller decides to suggest some price that is higher than what the buyer can get on the market, well, the buyer is not going to buy internally, or usually not buy internally for a price higher than what it can get out on the marketplace. So that's typically the ceiling. So the floor is the seller's variable costs. The ceiling is the buyer's market price, or what it can buy the same product for on the market. Now, there are a bunch of different ways to look between those two numbers and make a decision, but those are essentially the two main numbers you need to be focused on. Now, this book and many other books, in the real world, I'll just say that all of these decisions that they're trying to make are usually trumped by one other primary decision. The true decision of transfer pricing a lot of times is the tax jurisdiction. Rather than trying to figure out what the variable cost or what the market price is, you would rather have the division in the lowest tax area to report the most profit. So, for example, Apple has a ton of overseas sales, but it reports all of its overseas sales through Ireland because they have a special deal with Ireland, and they put their headquarters there, or at least nominally they put their headquarters in Ireland so that they could report all their international sales through the lowest tax bracket. And that's the same thing internally in the U.S. is that some places, a lot of times big companies set up deals with municipalities or even states or counties, that to get a tax break. So why wouldn't they want to report as much of their, why wouldn't they transfer as much as their profit to the place that charges them the least amount of tax? So even though there are all these other things, and granted, they are considerations, I would say if you talk to most corporate people, that the true decision is, what's the tax rate? Where is the lowest tax rate? That's where we're going to transfer that's where we're going to manipulate the transfer pricing. And there are some IRS guidelines and guardrails around this. And if anyone's interested, I can talk about that at some other point. But you can't just willy-nilly assign all the profit to one place. You have to have some justification, at least from the IRS point of view. So let's take a look at the book reported on different models. Market price, that's kind of what we're talking about. And the thing to take away with market price is that if there is a robust and liquid, deep market for whatever you're selling, then it's usually the easiest and most fair thing to just use transfer prices at the market price. Because you have to remember, if a buyer wants to buy internally for less than market price, well, the selling division has to basically say, okay, we're going to forego some profit. So whatever cost reduction the buying division gets is at the expense of some of the selling division's potential profit. So why do all that shifting when if you can have just the market price be what you buy and sell internally, then it ends up being kind of just an easier schedule to manage. The second one, variable costs. So these market price and variable costs are just what I was saying, are the ceiling and the floor. And the important thing to know about variable cost is if the seller has excess capacity. Because if we look at the next one, variable cost plus opportunity cost, if there's no excess capacity, that means basically the internal selling division they're selling all of their capacity to external users, meaning they are generating some profit and they're covering all their fixed costs. So if they have to sell for a lower price internally to a buying division, there's going to be some opportunity costs, the foregone profit plus the amount of fixed costs that they don't cover. So the best way to do that, if there's no excess capacity, is do variable costs plus whatever the opportunity cost. Basically, you're making the selling division whole. And from a total company point of view, that is probably the best idea to avoid any overall loss, overall increase in costs, even though there might be some unusual pricing between the seller and the buyer when the seller doesn't have any excess capacity. Another one is absorption cost plus market. You may remember back when we were talking about variable costing income statement versus absorption income statements. Absorption just means the regular GAAP, meaning what we report on financial statements. And remember, in financial statements is different from variable costing. Variable costing, we're just saying that is sales minus variable costs equals contribution margin minus fixed costs equals net income. Whereas on the GAAP, that's a variable costing versus fixed costing split. On the GAAP income statements, it's a product versus period cost. So what you would see normally there is on a GAAP statement, income statement, it would be sales minus cost of goods sold equals gross profit minus operating expenses equals net income. And so if you do an absorption cost markup, you're basically looking at it from a GAAP point of view, where you're taking into account both the variable costs and the fixed costs before doing a markup. But this type of market does cover your fixed costs. And in certain situations, maybe this is preferable. But just realize absorption cost just means you're looking at it from a GAAP standpoint. And when you talk about a GAAP standpoint, you're looking at it at product costs. Product costs include the fixed costs that are manufacturing fixed costs. Lastly, they say there are negotiated prices. Well, okay, yes, the buying division, the selling division, maybe for small items that would be good or would be okay. Upper management might not care. But honestly, for most situations, there's upper management doesn't leave it to the divisions. It's usually a top-down decision saying the upper management is telling divisions what to do. On small products, possibly, there's probably no big deal about that. Okay, let's take a look at the next two items. Okay, learning objective 3, return on investment and residual income. Well, if we've got large subdivisions of the company, we need a way to measure them. And so the learning objective 3 and learning objective 4 is talking about different ways to I guess, measure and therefore manage the performance of these divisions or these segments. So ROI, return on investment, you notice here, they're considering these segments to be investment centers, meaning they're not only profit and loss, they're managing their own investments, their own asset base, their capital expenditure. And so the basic return on investment is going to be income over assets, the investment center, income over assets. Now, return on investment, if we go down here, return on investment is made up of two other equations, investment turnover and return on sales. So let's look at investment turnover. Investment turnover is sales over the asset base. Now, what does that mean? Well, remember, whenever you're looking at an equation, always say to yourself, it is however many sales over $1 of asset, meaning for every dollar of assets that you have, how much sales do they generate? And that is you only want to have the amount of assets necessary to run your company. And so a more efficient company can take fewer assets and generate the same amount of sales. And so in general, this is a measure sort of efficiency and effectiveness. If you can take fewer assets and generate the same amount of sales, then your investment turnover is better. So companies are not designed, or you shouldn't think of companies as wanting to acquire assets. You want the minimum amount of assets necessary to generate the sales. Now, if you need more assets, well, that's fine. You just buy more assets, but the idea is the assets will help you generate more sales. So when we talk about investment turnover, we say for every dollar of assets the company has, how many dollars of sales do they generate? When we talk about return on sales, so sales is the top line number, right? And income is going to be the net income. That's going to be the profit. So if sales is the top line number, income is the bottom line number. So for every dollar of sales, how much is profit? Well, obviously that can't go over 1. You can't make more profit than you do in sales, but there's going to be some percentage, right? There's going to be, what's your overall, it's sort of like margin. What's your overall margin? But if you notice that sales is in both of these equations. So return on investment is investment turnover times return over sales. So if we take these two equations, you can see that we could algebraically just cross out sales, right? They cancel each other out. And so what we left with is income over assets. Income over assets. And so what are we saying? For every dollar of assets, how much profit do we generate? Right? So that's the combination of these two. Now, they make a big deal about this without really telling you why. Hopefully in your finance class, you'll have encountered the DuPont equation. The DuPont equation is a series of 3 equations that go together, that we go all the way up to return on assets. So this is, they're sort of tipping their hat towards that equation and the fact that it's important, or it's an important part of analysis, not necessarily a huge part of managerial accounting, but that's where they're trying to drive this information, that this is part of that DuPont equation, that whole idea of financial analysis, and this is the part that's applying to, they're kind of slipping it in here among segment reporting. So we've got return on investment, which clearly is not a very difficult equation. more more is in the explanation of what's going on here and what does it mean. And the next one is residual income. This is the amount of income over minimum return on assets. So if you have an asset base and there's a minimum return, now where does the minimum return come from? Well, again, this is another financial class. If you've studied the weighted average cost of capital, basically that means the difference, the sort of combined effect of how much, if you borrowed from a bank to buy your assets, well, what was the rate that you borrowed at? If you borrowed at 10%, well, whatever dollar amount that you ended up buying assets, you have to have a return of higher than 10%. Otherwise, it wouldn't be worth it, right? Because those assets have to generate at least 10% before you pay back the interest on the loan. Now, it's a little less clear when you issue stock. What is the return? But that's part of the finance class, hopefully, is that you understand the weighted average cost capital says that even when you issue stock to generate cash or capital to buy assets, that there is some expected return from the marketplace on your stock. And whatever that expected return is sort of like the interest on a loan. You have to achieve that expected return. So without going into extreme depth in this particular book and in this chapter, they're just going to give you the minimum return on assets. So if you have 10 million in assets and the expected return is 15%, well, then you need to have generated income at least of 1.5 million, and whatever over that is called residual income. In other words, that's the amount of income that you take away having satisfied the required return. Lastly, we're tackling the balanced scorecard. Now, we've already done a case study on this and had a more lengthy Harvard Business Review article on this. And so if you were looking for information on that, on balanced scorecard, I'd redirect you there. But I will go over the basics of it here. And there will be one just sort of definitional question on the homework, and therefore there'll probably be one definitional question on or possible question on the quiz and exam. So it's pretty straightforward. Balanced scorecard. Remember, if you're looking at our learning objectives, so the first one was segment reporting. How do we add on some additional divisional margin, segment margin, and segment income. Transfer pricing, what happens when we sell between the companies. ROI and residual income, how do we measure the performance? Well, this is another performance measurement. So whereas ROI and residual income are strictly financial, balanced scorecard recognizes that in order to make good decisions about the performance of your divisions, about your segments, you need non-financial information as well, financial and non-financial. And if you've been listening to the lectures, I think you've probably heard me say several times that don't get stuck too hard in the numbers. You want to calculate the numbers correctly, but remember the numbers, at least from a senior management point of view, is the beginning of the discussion. There are a lot of other qualitative things to take into account before you make a decision on something. So here, balanced scorecard just recognizes that there are many other things that you want to consider. Here are some common categories. Financial, well, that's our starting point. Customer, well, you can't just, stare at your own, belly button and wonder if you're doing well. You have to get some external feedback, right? So customer feedback is good. That's the end user. You want to make sure your internal processes are efficient and effective, making sure that you're doing things correctly. Innovation and learning, that's sort of a continuous improvement sort of process. There are other things you can look at, but those are typically the four core ones that we look at. And it's important within each category, you want to have a trailing and a leading measurement. In other words, trailing looks back at what you have done, a trailing measurement, and a leading measurement says this is sort of predictive of what the results might be in the future to, I guess, either, to give you warning if it's bad or to give you, good results, looking forward to good results. So an example, number of repeat customers. Well, that's sort of a trailing one, meaning you did your job. If you kept if you kept or increased the amount of repeat customers, you did what you were supposed to do in the past. But if you've got a measurement that talks about a lot of complaints, if complaints are rising, that might be a leading measurement saying you could have some potential problems in the future. Or, you could have a reduction of complaints, meaning you have more repeat customers in the future or better customers in the future. It's important to remember that because the balanced scorecard uses more than just financial information, it could be the first place that people go to look at the strategic goals of a company. And that's part of the reason why we had the case study, is to not only understand the financial impacts or the financial goals, but what are the overall goals? And if you can, now, not every strategic goal can be quantified into a balanced scorecard measurement, but a majority of them are going to be. So it's at least the first place to stop when you want to understand a company's strategic goals. If they thought it was important enough as a non-financial measurement to incorporate it in their balanced scorecard, it probably means it's pretty important to the company. And that's why when we looked at the Barrett Gold case study, that we were looking at things such as the response of the local jurisdictions to putting mining equipment, etc., that sort of thing. And what was it called? The whatever, let's see, it was called. I want to say ESG, that's right, environmental, social, and governance. So those were some non-financial measurements. Okay, well, let's take a look at the homework. As you can see, we've got 4 items on segment reporting, 2 on transfer pricing, and then 1 on ROI and residual, and no calculation on the balanced scorecard. And here we're looking at all the different, sort of the original thing was looking at contribution margin. Then we have 2 on looking at the segment margin. One calls it division, one calls it product, and then looking at the segment income. Just recognizing when we look at a group of numbers, which ones do we need to pick for what. Transfer pricing, we got 2 questions on transfer pricing, and then 1 on ROI and residual income. Okay, let's dig into those. Okay, so these first 4 questions, 9, 10, 11, and 12, are all similar in that they deal with different parts of segment reporting. So let's take a look at the segment reporting, what the overall, so this is going to be, let me get this in view. This is going to be number 9 through 12, and they're all going to use the same format. We're going to be using sales minus variable cost equals contribution margin, and that's what we've known before, minus, and I'm going to say this is going to change, instead of fixed cost, this is going to be direct fixed cost, which will give us our segment margin, then minus allocated costs. Allocated fixed costs is going to give us our segment income. And different questions are going to ask different parts of this. Just realize how much or how little you have to do for each of these problems. Let's take a look at the first one. It says, what is Division A's contribution margin? So that basically says here, we just have to go down to this level. We don't have to do everything. So if we look at Division A sales revenue, 720 minus variable costs for Division A is 144. And that's going to be a total of 576. And 576, let's just make sure that's right there, 576. So notice there is a whole bunch more to it, but this particular question is just asking here. So we're going to have 2 questions that ask as far as the segment margin, and 1 more question that'll ask as far as the segment income. Next one, number 10. This one's looking for B's. Now here it does say segment margin, which is good, but they don't always say that. Just realize segment is, let me see, I didn't make my cursor. There we go. Just realize that the segment is the generic term. They have provided 3 different types of segments. There's a division segment, a product segment, or a territory segment. But they don't always say that with the margin and the income. Here they do division segment margin, which is appropriate. I think that's proper. When I do this on the quiz and the exam, I will make sure to say segment so that you can know which one it is. You'll see in the next question, they just say product margin, but product is a type of segment, so therefore we're still talking about segment margin. So what do we need for, so we need to go down to here, right? To the segment margin. But that also means that we don't really have to calculate this intermediate contribution margin. We just need the 2 things. We need the sales minus variable cost minus the direct fixed cost that will give us the segment margin. So we don't even have to calculate that. So sales for revenue for division B is 1080. The variable cost for B is 216. I don't need to calculate that. Can if you want, but it's just another intermediate term. And if they're not asking for it, why calculate it? Direct fixed cost for B is 240. And so when I take these out together, that's going to be 624. And 624 it is. Now I realize you all have different numbers, but you have the process by looking at this. Okay, let's take a look at number 11. Number 11. So here they say product margin. They don't say product segment margin, but that's what you should realize. Let me bring it into the full preview. So product is one of the 3 different types of segments. So this is a product segment margin. So even though they don't make it clear, they are just asking for another segment margin. So let's go ahead and let me run this here a little bit. This is for the light roast, and the sales revenue for light is 720. The variable costs for light is 408. Again, we don't have to calculate contribution margin unless they ask us. The direct fixed costs for light are 90. Therefore, our calculation here is going to be 222. And it is. Okay, last of the 4. So we had 9, 10. So 9 was just contribution margin. 10 and 11 were both segment margin, although they had slightly different wording. And 12 is going to be our segment income. And again, we're talking about the product. But here, instead of saying product segment margin or product margin, it's just saying product income. But just realize this is going down to the segment income. So the segment income is not only taking the direct fixed cost for that segment, but taking the allocated. And as we talked about, the allocated fixed costs are by upper management. They have additional manufacturing costs that they're not exactly sure, or they can't trace directly to the segments. So they have some manner of allocating it. Sometimes it could be fair, sometimes not. So here we've got the dark, and we're going to go all the way to segment income. So therefore we don't have to calculate the segment margin. We just have to have the sales plus the 3 things that we're subtracting. So the dark sales revenue is 810 minus the variable costs for dark is 234 minus the direct fixed cost for dark is, okay, so they've added a partial 1,000. And then allocated fixed costs for dark is minus 67,500. So I guess I'll have to add the zeros here. And let's see what we got. So I've got 452,250. Oops, we didn't bring it to the preview. Let's see, 452,250. Okay, so that's correct. So as I mentioned, if I ask for a segment margin, I'll be sure to use the word segment in it rather than just product or something. I'll make sure I say segment. So this would be segment margin, this would be segment income, and this will be contribution margin. So just realize you will be given all of these costs, but you'll have to figure out which one of these you need to calculate. Now, if you remember, and I'm probably not going to do this one, is the unallocated common fixed cost. That's when we add all of the divisions together or all the segments together and take that from the total of the divisions added up together rather than marking them individually. Okay, now let's go ahead and move on to 13 and 14 are going to be transfer pricing. So let's look at number 13 here. Transfer pricing, we've got a lot of information. Essentially, we have a division, the foundry division, that is selling both to external customers, but also to an internal customer, the assembly division. So it's foundry is the seller, assembly is the buyer. Here is the information by division, by customer for the seller, both internal and external. Assembly has just received an offer from outside supplier to supply parts at $653, and it looks like we're supplying internally at $825. So we're supplying it to them at $825. They now have a new offer for $653. The foundry division manager is not. So the seller, the foundry division is the seller, is not willing to meet this new price that they were able to get from the outside. She argues that it costs her $675 per part to produce and sell the assembly, so she would show no profits on. Okay, sales to outside customers maximum $300,000 per. Verify first of all that the foundry division $675 is the correct amount. Okay, so the per unit costs are variable cost per unit and fixed cost per unit. They actually give us the variable cost per unit right here, $5. And the fixed costs are going to be, well, here are the total fixed costs, and the maximum that we're going to sell to, or the amount that we're selling internally is $400,000. So we would take $700,000 in fixed cost divided by $400,000, and that's going to give us $1.75. So that would be per unit cost of $675. Verify. Okay, so that's verified. And then they say, could the foundry division meet the $653 price? So, you may wonder, any lower than $675 and we're losing money. We can't, our variable costs are $675. So therefore we need a minimum of $675. Remember I said that's the floor. Now unfortunately, this is kind of a common occurrence, even though when you've shown the other managers the information, they may not totally believe it. They may need to see additional information, even though it's just the same information restated. So what they're basically saying, here's the per unit. If the per unit doesn't convince them, they say, well, show us the total numbers. And that's what they're basically asking down here, is to total it out. So what would that mean? Well, sales would be what? It would be this 653 times 400,000, right? And that's going to come out to 2612. And then less variable costs. Well, the variable costs we already know are 5 times 400,000 units. And that's going to be 2 million. So our contribution margin, our total contribution margin, is going to be 612. And we know from our previous thing up here, it's fixed. The fixed costs are 700,000. So if they wanted to say, "Oh, we're not going to lose that much," it's only 22 cents on the. It's only 22 cents difference on the per unit cost. They may think, "Oh, but that's not going to end up being that much of a cost." Well, you can show that the actual net loss here is going to be 88,000. So, substantial. Okay, well, let's see. Fill in the correct responses. 5, 175, 675, 2612, 2,612,700,000 minus 88. Okay. Let's take a look at the next transfer pricing thing. And so it says here no opportunity cost. That means, if you kind of remember, it doesn't always mean this, but it generally means no opportunity costs mean there is excess capacity, because we typically start talking about excess costs when we don't have excess capacity. That means we've got to steal some volume from our existing customers to deliver some volume to new internal customers, or additional volume to internal customers. And therefore you have to say, well, what did I lose by not selling to my existing external customers? And that's typically the opportunity cost they're talking about. So when we say no opportunity cost here, it's sort of implying that there is excess capacity. So here, number 14, the van division of Motorcar has offered to purchase 180,000. Okay, so we have two divisions, a van division and a wheel division. Has offered to purchase 180,000 wheels from the wheel division at $44 per wheel at a normal volume of 500,000 wheels per year. Production costs per wheel for, okay. So the wheel division are already producing 500,000 and selling them to someone else. And internally, the van division has now decided they want to purchase 180 on top of the 500,000. The wheel division has been selling these outside to $60, so their costs are 48 and selling for 60, so they're making 12. Capacity is 700,000, so yes, 500,000 of what they're already making plus 180,000 of what the internal division is proposing to buy does not exceed although it's close to capacity, but it doesn't exceed, so there is excess capacities. The van division has been buying wheels from outside suppliers at 57, so they are currently buying for 57. And what are they offering? They're offering 44, and our costs are 48. So the first question is calculate the benefit to the wheel division. Okay, so from the wheel division's point of view, you have to think of this as when back when we were talking in the short-term decision making, when we had a special order. Remember when we had a special order, in essence, this internal purchase is sort of like a special order, in that we're already making 500,000 and we've already distributed the costs. So these are the costs across 500,000, meaning we have covered all of the fixed costs in the 500,000. So as long as we have capacity, if we're looking at a new special order, our costs to make the special order, to make the increase, is really only the variable costs. In other words, it's only the cost necessary to build each additional item, because the fixed overhead is covered by, remember the relevant versus irrelevant costs. So the fixed overhead is already covered by the normal volume of 500. In other words, we're sticking the fixed costs to our external customers, but because this internal customer is adding on top of our volume and we still have capacity, we're not charging them. We're not spreading the fixed costs over to them. We're just going to charge them the variable cost to make the additional items. So what is they're proposing the sell price, or the purchase price, I guess, which from the wheels division, it's the sell price of 44. And if we look at our variable costs, it's 15 plus 20, 25 plus 5 is 30. So our variable costs are 30. So therefore, if the wheel division, as long as it has excess capacity, will make $14 per wheel on this. From the standpoint of the company, will the internal sale be beneficial? Okay, so what they're really asking is, well, we know it'll be beneficial to the wheel division. When they're asking about from the standpoint of the company, well, as far as we know, we only have these two divisions, the van division, the wheel division, or these are the only two affected. So what is the effect on the van division? Well, this is the old price, right? The old price was $57. But what is the new price if they buy it internal? The new price is $44. So they're saving $13 per wheel. The wheel division is making an additional $14 per wheel, selling the additional amount to the van division, and the van division saves money. So when we add these two up, the net benefit to the company is going to be 27. So the answers are going to be 14 and 27. Yep. Okay, let's take a look at the last one. This whole chapter, because it's sort of some odds and ends, is a little shorter, which I'm sure you're okay with. Last one. We have number 15. And this is the ROI residual income. Just remember that ROI is going to be income over assets, and the residual is going to be the amount that is greater than the minimum return on assets. And you'll see what I mean in a second. So here, Mustang division of Detroit Motors had an operating income $900,000, net assets of $4 million. Okay, so the first one is going to be income over assets equals, my thing went quiet, 900 divided by 4 million is going to be 0.225. And what are they asking? Round to 3 decimal places. That's what it's at. B, compute the residual income. Okay, so here it says that our rate of return is 16%. 16% on the 4 million. So we're going to take the 4 million times 16%. That's the minimum that we need to get. And that's going to be 640,000, right? But we got 900,000. So 900 minus 640 is going to be the residual. In other words, this is the minimum return on assets, right? And how much more than the minimum return did we get? So 900 minus 640, that equals 260. So this is the residual income. This is the buffer, I guess you could say. This is the excess over what the minimum that we have to make. For C is basically we're going to do it again, but they are doing a what-if scenario. C, they say the Mustang division has opportunity to increase the operating income by $250 with an $800,000 investment. Now, what they don't ask, so they ask you to recalculate the ROI and the residual income, but they don't ask you, should we do it, right? In other words, you've run these calculations. Now, what is the answer? Should we? Because they say it's an opportunity. So let's first of all run it again. So what would the new operating income? It would be 900 plus 250, or 1,150,000. And the new asset base is not going to be 4 million. It's going to be 4.8 million. Right? So that is 23958. So what do they want? Round 3 decimal places. So that would be rounded up to, I guess, 240. And D, finally, is compute the Mustang's residual income. Okay, so it's not 4 million, right? That's not the asset base. It's now 4.8 million times 16%. And that means the minimum return on assets is we need to make 768,000. But what did we make? Well, at least we're proposing that we would make 1.15 million. So 1.15 million minus 768,000, 768 is going to be, these are in thousands. 382,000. So these are the answers. So the question, the unasked question that we'll answer is, should we do it? Well, you notice by investing the 800,000, we get 250,000. And if I would just to divide 250 by 800, it comes out to 3.1. Now notice the 0.31. The 0.31 is higher than our existing. So the incremental amount is going to drag this up. And in fact, it doesn't drag it up a whole lot, but it brings up the overall rate to 0.24, meaning we should do this investment because not only does it generate more residual income, it also brings up our efficiency on our return on investment. So this would be a good opportunity. And let's just double check, make sure that we got the right numbers here. 225, 260. They didn't do it to 3 decimal places, but 0.240 and 382. Okay, well that looks like all of the questions on this. They're not that tough. Just have to make sure you understand what's going on and the equations. Otherwise, it should be pretty good. Okay, as usual, if you have any questions, let me know. And we'll be putting out the final lecture homework video here shortly. Have a good weekend.